Welcome to the webinar of today. So we have a topic that is a question. Uh, that question is the crash of everything starting or is close to start? Uh, what is happening? Because we hear the bell everywhere about a big crisis, a big crash coming. But I've been hearing that bell since long time. I think at least 3 years. Many of us, we thought that the crash was coming during the COVID crisis, especially with the big drop that we have during the month of March of 2020. Many investors, researchers, analysts, they thought about the crisis starting at that moment, but then we had exactly the opposite. We saw a strong recovery of all the economies worldwide, creating new highs in different indices. And that is triggering the question again: is really a crash coming? Are we going to face a recession? What is going on? What is the bell that we should really hear and pay attention to? That's why I think it's interesting to go through different indicators I find reliable and useful. And I will say why I don't believe a crash is coming. Why this big crisis that everybody is announcing is not going to happen, because everybody's expecting this since long time, based on all indicators and different occurrences in the past. But that doesn't mean that we are going to fall exactly in the same. Yeah, and then we will see why I think this is not going to happen. Okay, so I will share the PowerPoint presentation with you. Okay, we'll have a quick intro because we don't have too much time. The time is limited, as you know, and we will jump practically directly to the macro scenario and try to understand what indicators are more reliable in order to foresee a big crash or crisis coming. And then we will analyze the world indices, forex, energy, and cryptocurrencies, how they currently are at this moment. Are these corrections? All that is happening is really the beginning of this macro bear market or not? Yeah, that's what we will try to answer today. If you have any question after the webinar, please send those questions to info@thefinancialforecast.com, and I will give an answer to all of them. If you want the PDF presentation for today, the same, please just send me an email to info@thefinancialforecast.com, and I will send you the PDF from today. We will be checking forecasts. If you want to see those forecasts again, they are available for free in our website, in thefinancialforecast.com, in the tab called Free Forecast. And if you want to have a quick chat with me one-on-one, you can book it for free, 20 minutes, and you have here the address. Yeah? Also, you can request those 20 minutes through our website. Okay, I'm going to skip financial forecast. Yes, this is interesting. So we are going to analyze financial markets as they were fractals, and those fractals are reflecting the emotions shared within all the intervenants of those financial markets. Yeah, that's important to understand. So for us, financial markets are fractals. Now we will start with this macro scenario. So what I find very interesting is to cross the unemployment rate. Unemployment rate is always a reflection of how the economy of a country is. If we are really in a crisis, we are crashing and the situation is not good, then unemployment rate will rise as a reflection of this situation. And the opposite, if the economies are prospering, are growing, and everything is okay, you will have an unemployment rate that is decreasing or is steady at a very low rate. And we can see a very interesting negative correlation between unemployment rate and Dow Jones. Yeah, we'll see later that Dow Jones is highly correlated with other indices like the S&P or like Nasdaq or like FTSE or DAX. Yeah, all the world indices are really strongly nowadays strongly correlated. But we can see this nice behavior, this negative correlation between these two. And we can see that in every big crisis that we had in the last 20 years, the unemployment rate increased and the Dow Jones dropped. That was the case in the 2000, early 2000, yeah, with the dot-com bubble. Then we have the financial crisis, yes, with the mortgage in 2009, 2010. So we have this drop of the Dow Jones and a big increase of the unemployment rate as a reflection of this big crisis happening. Then we have really a very nice bull market that had a strong correction during the COVID crisis we mentioned before, March 2020. Why? The Fed also announced that they were going to increase interest rates, and the emotion among all this mass of investors and different intervenants in the markets got into crisis, into really panic, because everybody knows that the debt in all the countries, most of the countries, is really high. Central banks keep the debt in order to keep the economies moving. That's not new. So the fear about not being able to cover those debts, because central banks were starting increasing the value of the money and reducing the quantitative easing, that creates really a big panic and a big drop. Plus, all the situation related to COVID, first time with a pandemic since long time. In the new economic era, is the first time we are facing a really big pandemic. And that uncertainty created this big drop. Plus, lockdowns and economy was more restricted and more difficult to manage. But then the sentiment turned around and we had new highs in the Dow Jones, S&P, and other indices. And that was related always, this is very important to understand. Nowadays, all the financial markets are based on confidence. If there is confidence on what central banks are doing, or on what governments are doing, then there is no fear to a crisis. That's why we will continue seeing new highs in the different financial markets. On the opposite, if we don't have confidence in the country, then in the central banks, then everything will change. It's not the same that the US increased the debt than a Latin American country increased the debt. And everything is based on confidence. The confidence that we have on those central banks, on those countries. So that's why the US can keep this monetary policy without fear, because we have confidence in that country. We have confidence in that bank, central bank. The same is happening in Europe. Strong economies, we know how they behave. We know why central banks are doing what they are doing. So we don't have doubts about the performance or the economic performance of Europe. So we have confidence on them. That's why we in Europe have a similar situation than in the US. We have strong confidence on how everything is managed. So after the COVID, during the COVID crisis, we had this massive peak of unemployment rate, this big drop, a strong and sharp corrective phase in the major indices. But then everything's turned around and we have a very nice recovery, and unemployment rate is again practically at the same levels of a pre-COVID crisis. So that means that this means a strong recovery of the economy. Yeah. That is the first indicator. So we should see then in this bear market the unemployment rate increasing, but this is not happening. we see unemployment rate decreasing. So we don't have this negative correlation. That's why this is probably not the beginning of a big bear market, at least at this moment. Then let's analyze the correlation between the GDP, unemployment rate, and also interest rate and unemployment rate. Yeah, from one side, the GDP, the growth. We have, again, the same negative correlation that we have with the Dow Jones. Every time that the GDP drops, the unemployment rate increases. Yeah, this means, of course, the economy is not growing at the same pace. Something is not going okay. It's not going as expected. And the impact of this is an increasing in the unemployment rate. So it's reflected in the economy of every day. The same happened during 2009, and the same happened during COVID. But now we see that the GDP, the growth, reached new highs. And now it's a very good level, despite it is correcting from the last high. Yes, we have really a massive increase of the GDP, also as a reflection of the big drop that we had also with new lows during the COVID crisis. So we have this compensation. Now we are going back to normal levels. And that's why we don't see the reaction of the unemployment rate on the opposite direction. Yes, we don't have an unemployment rate increasing while the GDP is correcting, is dropping. Yeah, we are in a healthy levels of GDP at this moment comparing with the last 20 years. So there is no reason to worry about at this moment, and it's not reflected at the impact in the unemployment rate. When we see interest rate, we see also similar behavior with a negative correlation. Every time that the employment rate increases, the interest rate decreases to ease the economy. Yeah, 2000, 2009. We had the same during 2020, during the COVID crisis. Now we have a very low unemployment rate, and we are starting, the central bank is starting to increase these interest rates. But now the tone of this increasing, this hawkish tone, is changing. So now we know that this tone is not as hawkish as before. We are not going to have a lot of interest rate increase. Yeah, they are easing also with that because they want to see how the economy is adapting, especially to the inflation that we are having now. So that's why we don't see the reflection on the unemployment rate. That's why we cannot foresee a big crash or crisis coming at this moment. So we have three different indicators at this moment using the unemployment rate. Let's analyze the mortgage rate. We have the same mortgage rate peak before a crisis start, and then the mortgage rate decrease while the unemployment rate increases. Yeah, the same 2000 during 2009, and during the COVID crisis. And now we have this decreasing unemployment rate, and of course we have this reaction of increasing interest mortgage rate, also as a reflection of the increasing interest rate. But we are not topping probably at this moment. We don't see a change in the slope of the interest rate, of the unemployment rate. They are not increasing. That's why we cannot foresee also crisis using this, but we can see that probably the housing market will slow down because the mortgage rate is increasing, and probably prices in the housing market are at highest. So probably we can expect a drop in the activity in this market, but it's not reflected. We cannot expect a crisis yet because unemployment is not increasing. And the last one is the difference between the interest rate curve. Yeah, we are using 10 years and 3 months. The difference between these two, if they reflect an inversion, then we know that a recession is coming based on the last 30, 40 years. And we had every time that we were negative with this curve, that means when the blue line is below the black line, below the zero. So when we are recovering, we enter into a recession. We have this in 2000, 2009, and we had that also during the COVID crisis, much smaller than in the past, but we also had it. So we don't have a reason why to expect a new recession when we already had it. Yeah. That is short in time probably is because we learn from the past, and central banks and governments know how to tackle this better to avoid entering a long-term recession. But the recession already happened, the crisis already happened, and it was during the COVID crisis. Yeah, that's why analyzing all these different macro indicators, we are not foreseeing a big crisis coming. Probably what we see at this moment is a correction within a bull market. And if we analyze all the history of Dow Jones, we had much more bull market than bear market, especially big bear markets, yeah, big crisis. So that's why everything is pointing more to a correction at this moment than really a big bear market. If you have any question, please you can send it through the chat box. Yes, I hope everything is being clear until now. And this is the fundamental reason why I don't expect a big crisis at this moment. And I will analyze all these movements to the downside as a correction of prior bull markets. Yeah. World indices. We were talking about before a positive correlation. We're analyzing long-term cycles in this case. In most of them, yes, we have the S&P, we have DAX, the Hang Seng, and the Nikkei, all world indices. And the correlation is quite high. Of course, the growth is bigger in the S&P, and we peaked before in the Hang Seng, that is the blue one. Yeah, but the correlation is quite important, it's quite high in all these indices. And we had this nice bull market after the COVID, because bottom in the March 2020, and now this movement can be a correction of the prior wave to the upside. Yeah, so let's go to analyze what we see here. So I will go to the chart of the S&P. So you can find these graphics in our website in the financialforecast.com in the tab free forecast. And we are going to analyze this as a fractal. Yes, so we have the motive wave, the bullish wave from this low in 2191 with a max in 4,818. So it's really a big increase during part of the COVID, during part of the lockdown. Yeah, so economies were reacting very well. Also, we need to think that we are not living more in a physical world, 100%, that we are also living in a digital world. And a big part of the lockdown was tackled thanks to this digital world that allow consumption to keep going. And that is what kept also the economies in a healthy pace. Yeah, of course, a lot of areas, many businesses, they got an impact of it. But many others, they got a big benefit from COVID. And these chances we had to switch quickly to a digital world for a work environment, we could work from home, we could purchase from home, we could do practically, we had our social life through our laptops. We had our meetings through Zooms. So we were able to handle the situation quite well using the digital tools. And that's what's happening, and this is reflected here. So we analyze the corrective phase. So we have already 3 waves. If we go deeper in detail, and we see how many waves are building this corrective zigzag, we have 3 waves. We have 1, 2, and 3. If we analyze the length of them, so we already reached the attractor. Attractor is this red box, is where the price tend to go, and where we can find the maturity of the corrective phase in this case. And also, we have more chances of finding the maturity of this corrective wave within these 2 lines that are reflecting the ideal time, yes, for this corrective phase. And then is when you can connect very well the motive wave with the corrective wave in 2 dimensions. One is the length, that is what we analyze as retracement, and the other one is the time, yeah, the speed that is taking this corrective phase. And we are very close to all these levels, and we reached the attractor, and we had an important bounce from this place. And also it matches with the communication from the Fed that they are not going to be so hard with the interest rate increase. And that brings more oxygen, more relief, and less fear. And that's why also we can justify this reaction up. And this can be the bottom of this corrective wave. But it's important to understand that the sentiment is not clear while we are in these 2 dotted lines, the green and the red. Yeah, and we will do the same with the different graphics. In this case, we cannot confirm that the new bullish market is starting, yes, a new wave, until we don't break 4,709. Here's when we can find really a more strong sentiment and an easier development of the bullish wave. On the opposite side, if we break the 2,798, then the chances for a big bear market increases. Yeah, that means that we are correcting a wave of bigger degree. Yes, a bigger wave. So that means that we will have a correction for a longer time. Probably we are correcting this massive bullish market started in 2010. But at this moment, everything is quite clear. Everything is matching. So we are correcting the prior wave started at 2,637. And the corrective wave is clearly divided into 3 waves. Yeah, it's a clear and easy zigzag. Okay, let's go back to the presentation. The next market we will analyze is Forex. Okay, here we can see totally different from what we saw before with the indices. Here we have negative correlation. On one side, the main graphic, the one you can see with the candles, is the US index, US dollar index. And then the major Forex pairs. So we have the euro, we have the pound, and also we have the dollar yen. Euro and pound, they have a negative correlation, and US dollar yen, they have a positive correlation. That makes sense. Yeah, when we invert the pair, where is the USD? If it's at the front or it's at the back of the pair, we will have one or the other. But what is interesting to see here is we were behaving sideways since the last 5 years, 4 or 5 years. And now we are moving up again. So, but the behavior is basically sideways. So then let's move to analyze the euro dollar. And we had also an important reaction at the end of last week, and we continue with this bounce during this week. Yeah. Why the same? Of course, is the Fed is saying that they are going to be more easy with the increase of the interest rate that has a positive impact, and that happened when the prices reached the attractor, this red box. Yes, this red box belongs to the equal waves for the sequence started here with the maximum in 1.2555. This happened in February 2018. So we have a big wave going down, a corrective wave, and then again in a very flat formation that doesn't reach to make a new low from the prior one that we have here. This low is in 1.0340, and the minimum that we register now is very close to create a new low, but it's 1.0348. We didn't create a new low, and we were very close, but we see a strong bounce here in the lower line of the channel, plus in this around this support area that is 1.0426, 1.04, let's say, and we have this bounce up. What's happening? The sentiment can be turning at this point, and we will continue with this sideways market because the trend is not clear until we break 1.1758. We are talking about all the time long-term waves. Of course, from 1.0770 where we are today till 117, there is a big range if you are investing or trading in lower time frames. Yeah, for the long term, we still are sideways, and we probably need to test first this level 1.1758 before confirming a new bullish market starting. If not, we can see new lows, we can see even a new low mark, or even go to the parity at the moment that we are getting close to the new rate hike, yeah, from the US. If not, market will discount this. We will behave sideways, and probably later on we can start a new bullish market, yeah, for this pair. As the correlation is so big, yes, with euro pound, so we will have the same reaction in the long term and the opposite reaction in the dollar index. Okay. Let's move to energy. Then energy, in this case, we are comparing the natural gas and the US oil. Both are in a very strong bullish market. Yes, after reaching lows. If you remember during the COVID, we have a very, very low for the crude oil. It was close to 5, even zero negative in some cases, dollar per barrel. And everybody talks about Bitcoin and how Bitcoin increases. But don't forget about the crude oil that in 2 years went from $4 or $5 per barrel to 140 almost. Yes, it's a massive increase of prices of the price in 2 years. This can be related to the new entrance, the stop of the lockdown, and we coming back to normal life. That is increasing massively the demand of petrol. Also because the consumption during the COVID crisis didn't stop. So we didn't move. We didn't drive our cars, sorry. But everything kept moving, and logistics increases a lot. So that's why the demand of crude oil increases also. And now that we are back, we are adding more demand into it, and prices are massively increasing at this moment. So let's go to analyze the graphic. Let's go to the US oil. Okay, and we had a small correction during the last weeks, and then we had a bounce around the attractor. Yes, we reached it and we entered a little, but we had the reaction, the bounce. So all the closes happened above this area, and we are now entering in this area of new highs. Attention to the level of 1.2148. Yes, we cannot confirm that we are again in a bullish market until we don't break this level. Yeah, we can have this reaction up. We are around this resistance level, this 1.15. Yeah, we need to see reactions during this week. but we can get a bounce and then go back to the ideal time, the ideal speed for the corrective wave, and reach the low within the attractor, or move to the next red box that will give us a correction between 67 and 49. That also will help to decrease the inflation rate at this moment. A big part of the inflation rate increase is coming from the cost of the crude oil, the cost of energy. So we had a decrease now of the crude oil. That can be benefit for two things. One, we are going to put a brake into the inflation rate, and then it will make sense that the Fed won't continue increasing interest rate at the pace that they were saying before. So it makes more sense to keep a less hawkish point of view on this zone. So that's why keep an eye to this level 115, 1.21. If we can close above this level, the 1.21, then yes, we can expect a continued continuous bullish market to 250, 275. That's the first area that we can reach, where we can see maturity of the next wave coming. And if we analyze the internal structure of this, so we currently have 7 waves. 7 waves means turning a correction before a continuation. So we have 1, 2, 3, 4, 5 waves, the correction, and one very smooth wave up. So we have 7. That's why we need to be careful on understanding this as a new bullish market, because in terms of waves, of pattern, the pattern is correct. So we can see a continuation of the correction, of the sideways market. Keep a close eye to 1.21. And cryptocurrencies, the same. We are in a massive correction. Everybody is talking about the end of the crypto era. So that happened already before. It's not the first time we hear about that, about the end of the crypto. Of course, we have a very divided audience related crypto. You will find people that love crypto, and you will find people that they don't like it, they don't understand it. Okay, but it's there. It's a very strong asset. It gave a lot of very good opportunities, and of course, during the big variety of crypto that we have, not all of them are going to succeed, like happened with Luna, and the big drop that we have with that asset. But that doesn't mean that all the crypto is going to do exactly the same. Crypto is having a very good adoption, and in very parts of the globe, crypto is well seen, and will give a lot of new opportunities. Even now, we have more and more investment funds that use crypto as a main asset. So that's why we need to keep an eye, and we don't need to think that crypto is going to die at this moment, because probably not. It's a big correction as we had before. Yes, we have the peak, this peak with Bitcoin a long time ago. Then we have very, very strong correction, around 80% of the prior movement. Now we had again new highs, and we see a correction again, a very strong correction now in all the cryptos. What this graphic is showing us is this strong correlation that we have in the major cryptocurrencies. Here we can see Bitcoin, we can see Ethereum, Ripple, Cardano, and Solana. And all behave very similar. So let's check what we can see with Bitcoin. Okay, here we can see also a 3 waves correction from this top that happened in November last year, with a high in $69,000. Then we have a first wave, a corrective wave that reached the attractor, these green areas, yes, and in a perfect timing to then drop again and reach this new attractor to bounce up, yeah, to bounce, and didn't close yet above this box, but this week is trying to close above. So we don't have yet the confirmation of the turning. Yes, we see a very good reaction of this bounce that's happening within the attractor area, but we still are open to have new lows in this crypto. The support is quite clear. The support is around 31,800 and 29, $1,000. Yeah, so this is where now the price is trapped. So that's why it's good or it's healthy to see for a bullish continuation, for a continuation of these upward movements, to see a close above 31,000, yeah, and above this attractor. To then, yes, start analyzing in the short term what are the component waves and how we can build up or construct this pattern for a continuation to the bullish side. In any case, for this long term, until we don't break 59,000, 59K, we can confirm a new bullish market. But yes, what we can analyze in the short term is how this pattern is built, how it's connected with the prior zigzag, to analyze the chances to be a corrective wave for a bearish pattern, or is a new bullish sequence that is just starting. Yeah, but at this moment we are having this bounce. We have good reaction within the attractor. The same happens with other cryptocurrencies like Ripple. They are bouncing from attractor levels. So we need to give a little more time. Volatility is decreasing. We came before from a volatility peak, so makes sense to see this drop on volatility, and then see what happens once the volatility cycles start moving up. But at the moment, good reaction from this attractor, yes, can be a barrier for a bearish market, but still it's not confirmed because we are in this support resistance area of the, let's talk about 28. Yeah, we can see this low around 28,000, and here we have the 34,000. Okay, perfect. We did all the review on time. You know that you can send any question, you can request for this PDF, uh, just texting me to info@thefinancialforecast.com. If you want to see the forecast again, you can just visit our website and go to the tab Free Forecast. And I hope you found this webinar useful, and I see you next month in the coming webinar. Thanks a lot and have a nice week. Bye.